Good day, everyone. This is Professor Roger Flores, Associate Professor of Central Mindanao University, the professor of this subject, Engineering Management. This day, we are going to discuss Chapter 12 of our subject entitled Managing the Finance Function. So in this chapter, we will be able to determine some of the important things that we should know with regards to financial matters and financial aspects. No? Actually, being a manager of any organizations, company, we should know the financial status of our organization or company. So to begin with, we have this chapter 12. This is managing the finance function. We have this chapter 12. Okay, so this is the content of chapter 12, what the finance function is, the determination of fund requirements, sources of funds, the best source of financing, the firm's financial health, indicators of financial health, and risk management and insurance. So these are the contents of this chapter 12. Okay, for the question, what is the finance function? Okay, this is a management responsibility that deals with the procurement and administration of funds with the view of achieving the objectives of business. Okay, so that is very clear that this finance function is one of the responsibility of the manager to procure, to find sources and the administration of any funds, no, with the view of achieving the objectives of the organization or businesses. Okay, so that is finance function. This is the finance function process flow. Okay, first we have to determine the fund requirements. Okay, so how much we need to our activity. Okay, how much the fund that we need to conduct our company's activity. No, so we should know how much the needed funds or the funding of the activity. Okay, next we have the procurement of funds. So sources, then how we are going to find or the sources of our funds, no? So we need to know the possible sources of the funds to perform our or to achieve our the mission and objectives of the organization. Next, we have this effective and efficient use of these funds. No, so otherwise we should know, and being the manager, we should know how these procured funds are or will be being used and utilized. No, so we should know as the manager. Okay. Then we have this determination of funds requirements. So we have this how you're going to determine how much funds needed. No, okay. So first here is to finance daily operation. So that is first needed amount or funds, no, to finance the daily operation. So anyway, later on we will know what are the expenses that expected, no, and in the daily operations of our company. Okay, so number two, to finance the firm's credit services. Okay, so we cannot deny, or we cannot, our customers, our clientels need services, no, credit services to continue their activity, their businesses, or when it comes to engineering, so that they will be able to continue the construction activity. So we have these firms credit services, no. So number three, to finance the purchase of inventory. So maybe some of you, this is the first time that you heard about inventory, no? So this inventory is synonymous to stocks. So that is one requirements, no, or one expenses, one of these expenses of the company to purchase inventory, or the stocks of the activity of, or the raw materials of the company, no. So number four, we have the finance the purchase of major assets. Okay, so we have several types of major assets, no. Later on, we will know that some of the major assets of the company is the building, the plant, no, and the equipments. So these are some of the major assets, or land, no. So we need funds to purchase all these major assets, no. Okay, so next, financing daily operations. So this is what I mentioned a while ago, no. So what are the possible expenses for these daily operations? So we have here, number one, we have the wages and salaries. So that sometimes we are not so sure what is the difference between wages, or wage, and salaries, no. So just to differentiate it, what is the, okay, the difference between wages and salaries? These wages are those payment of the laborers, or the subordinates working daily, no, or in Cebuano term, that is Pacquiao basis, no. So we have these wages, especially the daily payments of the services of our laborers. Then when it comes to salaries, so these are the payments for those who work in monthly or weekly basis, or monthly basis, no. So we have that salaries, or salary. Okay, so next expenses that needs financial support is rentals. Okay, so maybe we rent, for example, offices. We rent equipment, heavy equipments, for example, or any other materials that not available in our company. So we need to rent. So we have to. This is another financial expenses, no, daily expenses. Okay, next we have the taxes. Okay, so we know that tax, or taxes, is the life and blood of our government. Then we have this. We should have to pay taxes, no. So that is very important. Next is power and lights. Okay, of course, we cannot deny that all equipments, materials, maybe devices in our offices, or in our company need to be supplied by electricity. So we have to pay this power and lights. Okay, lighting system, or yes, electrical energy consumption of our operations. So we have to pay this one, no. Number five, we have here the marketing expenses, no. This is like those for advertising, entertainment, travel expenses, no. So this is for the clients and the potential investors, or the potential customers. Then we have to expense for entertainment and maybe travel expenses for our subordinates or people, our marketing forces to uh, to visit, no, our potential customers and clientels. Then telephone, telegraphs, stationery printing, postage, and etc. Then number six, we have these administrative expenses. No? So these are some of the expenses or funds allocated for the audit, the COA, and legal services, and consultancy if we have consultants. So consultant services and professional services. So for our engineers, for example, legal services for our attorney. From time to time, we need the legal services of the or legal minds of the legal people or the attorneys. So we have these another expenses for daily operations. Okay, so financing the firm's credit services. Okay, it is said, I mentioned this a while ago, that oftentimes unavoidable that firms to extend credit to our customers and clientels. So we have to help them so that they will be able to continue their projects or their activities. And it will also be advantageous to our company, our firms, no, if we are going to help them through credit services. Okay, so next, financing the purchase of inventory. So as I've said a while ago, that inventory that we mentioned a while ago is synonymous to stocks, no? So it is said here that maintenance of adequate inventory is crucial to many firms, no? So that is very important, that we will be able to always evaluate the available inventory, okay, of our firms, so that we will not be losing our time, so that whenever we need materials, logistics, for example, then we have this available inventory or available materials and logistics. So from time to time, we need to evaluate the availability or the stocks or the inventory of these materials. Okay, next we said here that many firms cannot cope with the delays in the availability of the required material inputs, no, in the production processes, so that this must be kept ready whenever required. Okay, now even in the construction materials, like for example cement, for example, um, these rebars. So we need to have to evaluate if these are still available in our inventory. Okay, so we have to purchase from time to time, so that our laborers, our workforce will not be working um, or they will not be in idle, no. So this should all so this should be always given this supply or material, so that there will be a continuous work or continuous processes. For example, if we are in the production, okay. Then we have also this purchase of financing the purchase of major assets. So I mentioned a while ago about land, plant, and equipment. These are some of the capital assets of the company. So if the company or the top management decides for an expansion of the production or expansion of the firm's output, then we should be investing more capital. Okay, so like major assets like plant, land and equipment and building, no? So these are some of the major assets that we are going to procure. Sources of funds, no? So some here we're going to enumerate some sources of sources of funds. It could be cash sales. Okay, so next we have collection of accounts receivables, no? Loans and credits, sales of assets, no? So cash sales, of course, that is the um, when we have this marketing of our output, then whatever the receivables as sales, cash sales, then so we can use that as a source of our funds. Then collection of accounts receivables. These are from the credit services that we extended to the clients and customers. Okay, so we have this collecting all these receivables. Then so we can use that collected accounts as our sources of funds. Next, we have these loans and credits. No? If we really need expansions, if we really need a big amount of cash or fundings, then we can apply a loan for to any financial institutions, funding institutions, and or credits, cash credits to any company that extends also their services, credit services, and or we can sales of assets, no? If we have, for example, assets that are not so useful, okay, we can let somebody buy it, and we will use that amount to be one of our sources of the needed funds. Okay, or we can have this ownership contribution. So maybe a company will have this is an organization that composed of investors. Then you can use the money of these investors and the advances from customers. Now we have okay, so maybe some of our customers or clients will pay in advance so that they will be in priority lists for the supply of our product or outputs. Then if they will pay the material that we're going to supply to them, then we can use it as our funding. Okay, so let's talk about short-term sources of funds, no? So what are some of the advantages and disadvantages of using short-term sources of funds? Okay, one of the advantages is easier to obtain. Okay, so because we have only a short-term conditions, then maybe the financing institution or yes, will be having only a few requirements. So it is understood that they will release the money, the financial or the fundings that we need each year. Okay, and then it is often less costly. So maybe because few requirements needed, then we need only few requirements, then it might be not expensive to acquire those requirements, and the application of these short-term sources or funds or application of this funding might be inexpensive. Short-term financing offers flexibility to the borrowers. Okay, so since this is a short-term only, this will involve only a less or small amount, then maybe the financing or financial institution is more flexible to the borrowers, no? But of course, we have also disadvantages. So we have these short-term credits mature more frequently because this is just short term, and then it will the coverage or the terms might be shorter, no? So maybe just 12 months, annual, okay? So that is one of the disadvantage, that it might be in a few months only, then you should have to pay all those credits, no? Then short-term debts may at times be more costly than long-term debts. Okay, so if you're going to apply these short-term credits or debt, then maybe the interest is much higher compared to the long-term debts. No? So that is all about, that is talking about interest. Okay, so we have supplies of short-term funds. One of these supply or sources of short-term funds is these trade creditors, no? So referred to suppliers extending credit to a buyer for use in manufacturing, processing, or reselling goods for profits. Okay. So these are the creditors that uh, that extends, no? So, or the suppliers that extend credit to a buyer. Okay, so for example, if we are going to give few days, few months for our clients or our customers to pay the amount of the materials uh, they purchase to us, then we are an example of these trade creditors. Okay. Next, we have this instrument used. So this is an open book credit. So simply in layman's term, just log it using the logbook. No? So we have this just list uh, the credited supply or goods and services that we extend, no? So log in, no, log book. Then trade acceptance. So just use the direct trading, no? Then we have the promissory notes. So that is very common, no? That you have to sign a promissory note to pay all these materials that the trade creditors extended. We have also another supplies of short-term funds, the commercial banks. Okay, we have several banking institutions that will lend amount money for their clients. No, these are the institution which individuals or firms may tap as source of short-term financing. So we have several banks that will help our business firms or our businessmen to business firms, no, to help them in their financial needs. So two types of short-term loans: those which are requires collateral, okay, or don't need collateral. So maybe some of us are not familiar about collaterals, no? So these are anything that give an assurance, okay? So anything that will give to the creditor, oh, to the creditor, so that there will be an assurance that the one that borrow the money or materials or services will pay. So we have to have this collaterals, no? Anything, no? That give an assurance to those who help, um, that they will be paid for these extended services. Okay. Number three, we have commercial paper house. Okay, are those that help business firms in borrowing funds from the money market. Okay, so for example, this is another firms that will try to borrow money for their clients. Okay, so for example, if we don't have money to lend, to extend to our clients, then we as a firm, then we have to borrow to somebody, and we will give or extend them to our clients, no? So this is borrowing funds from the money market. Number four, we have these business finance companies. Okay, so are those financial institutions that finance inventory and equipment of almost all types and sizes of business firms, no? So business finance companies that will help to buy to purchase the inventory and equipment of their clients, and their clients are or their customers, so that that clients or customer will be able to continue this business activities. So we will be the one to provide the inventory or supply and or equipment, so that they will be able to continue their activity. Factory companies. Okay. So are institutions that buy the accounts receivables of the firms, assuming complete accounting and collection responsibilities. Okay, so this is another supplies of short-term funds, no? So what does this mean? This factor company will assume the collection process of the credited material or amount, no? Okay, so for example, there is somebody that have credits to a certain company, then this is the third person that will be responsible of collecting the credited money and then give it to the suppliers, no? Or the funding institution. So something like a middle person to collect all the receivables and credits and amounts for the creditors in behalf of the creditors, no? And then we have the insurance companies, no? So we are already familiar with the insurance, no? So are also possible sources of short term funds, these insurance companies. So if our company is insured, then maybe the insurance has been matured, then we can get the capital, plus the interest of our insured money, and then we can use that as our short-term funds. Okay, so let's now talk about long-term funds, no, or long-term sources of funds. So this is classified into, the first one here is long-term debts. Okay, so long-term debts or credits. So we have this long-term debts subclassification. So term loans, okay, commercial or industrial loan from a commercial banks, commonly used for plant and equipment, working capital, or debt repayment. Okay, meaning to say that this is a kind of commercial or industrial loan from the commercial banks that give us a big amount, and maybe a condition of in paying this amount for several years, maybe 5 years, okay, 3 years or 5 years, and so on and so forth, no? So another one is the bond. It is a certificate of indebtedness issued by a corporation to a lender. Okay? It is marketable security that firm sells to raise funds. Okay, this is very common and okay, in a construction firm, no? That the end user or the owner of the building, for example, need to have this certificate or security bond, no? So that whenever there will be some financial problem of the contractor, then they will be using these security bonds. Okay. So we have these types of bond and feature. We have these debentures. So no collateral requirements. So small amount only. Okay, so number two, mortgage bond. Okay, this is more on applicable in the real estate, no? The mortgage bond, that is the monthly contribution or payment. So we need to have a bond so that whenever there is the delay of that payment or whatever problem in the payment, then this bond will be used, no, for to pay the monthly mortgage, no, or payment. Then we have this collateral trust bond secured by stocks and bonds owned by the issuing corporation. So collateral is used. This bond is used to give assurance to the one who extended their credit services that they will be paid later. So we have this collateral trust bond. Then we have the guaranteed bond, payment of interest or principal in a guaranteed by one or more individuals or corporations. So somebody will give a guarantee to the lending institution that if the borrower cannot pay, then this individuals or corporation will pay that borrowed amount. So we have this in the form of a guarantee bond. Okay. So subordinated debentures. This is with an inferior claim over other debts. Okay. Number 6, convertible bonds. This is a convertible into shares of common stocks, no? So convertible to a share of common stocks. Okay, so next we have number 7, bonds with warrants, no? Warrants are option which permit the holder to buy stocks of the issuing company at the stated price. So we have that number 7 types of bond. Then number 8, income bonds. Okay. So it pays interest only when earned. Okay, so we have that we will not pay the principal, but only we're going to pay that interest. So we call that one as it is, of course, it is also a bond, but it is just an income bond. So we have these sources of long-term sources of funds, no? So we have long-term sources of funds. Number 3, number 2 classification, we have the common stocks. Okay, this represents ownership of corporations and cheaper and more stable sources of long-term funds. Common stocks of the owner of the company and or of the corporations, the stockholders, no? So number 3, retained earnings. Okay, that supposedly they will receive dividends and the owner will not or the incorporator will not receive that dividends and just retain it to the company, and it will be used for this long term, okay, or these funds, no? So they can use this as a additional fund. So this they we call this one as retained earnings. That supposedly that is the share of share dividend of the stockholders, but they will not withdraw that. Then it will be just converted as a capital and additional funding of the company. Okay, so we have this the best sources of financing. Okay, we have these factors that you're going to consider to determine which sources of these funds will be best, no? So, number one is flexibility. So, we mentioned a while ago that if the lender is more flexible, then it is good, or the one that extends their financial services, credit services, if they are so flexible, then it's better, no? Compared to those very strict funding institutions. Then the risk, okay? So if it is not so risky, and the condition is maybe acceptable, and then if this is not risky to the condition of our company, then we will consider that as a best source of financing. Of course, the income. Okay, so we are going to consider also the income of that funding institution. Okay, then the control system, the timing of collection and conditions of payment, and other factors such as collateral values, the flotation cost, and speed of collection and payments, and exposure of the this financing or financial institution. Okay, so now let's proceed to the firm's financial health. So that being a manager, we should know the financial condition of our company. Is it are we in a good condition when it comes to money matters, financial aspects, no? So, but we should have to consider these objectives of engineering firms, for example. What are the objectives of the engineering firms? So, number one, to make profit for the owner. Okay? So, of course, if we are going to have these engineering firms like construction, material supplies, materials, equipment suppliers, so then we have to uh, understand that we have to make profit, no? We have to make profit, of course, for the owner. Okay, to satisfy creditors with the repayment and loans plus interest. Okay, so for those who lend to extend their credit services, then try to satisfy them by repaying all the loans and plus the interest or the credits that we borrowed, the amount, the cost, and the amount that we borrowed. Okay, so so that they will be satisfied for our our needs, no? Then we have also to maintain the viability of the firm so that customers will be assured of a continuous supply of products or services. Okay, so so that our customers, our clients is will be comfortable that they will be able to continuously supply their needs, either products, touchable products, or services. So we should have to maintain this viability of our firm, no? Then employed will be assured of employment. Okay, so our employees will be assured of our employment. Okay, so suppliers will be assured of a market, and so on and so forth, no? So otherwise, their stocks, their inventory will be bloated if they will not be assured with a good market of the product. Okay, so we have some indicators of financial health, no? So we can use the balance sheet, okay? And that sometimes this balance sheet is called statement of financial position. Okay, next we have the income statement. Okay, so this is the documents that shows the statement of operations, the expenses, the collectibles, the incomes, and so on and so forth. Okay. Then statement of changes in financial position. So these are the documents necessary which will indicate the financial health of our firms or our organization. Okay? So financial position, what is now the status of our finance, our money matters, our fundings, and so on and so forth. So we have also this risk management and insurance. What is a risk? Okay, so risk refers to the uncertainty concerning loss or injury. Okay, loss of material, loss of life, and injury of our laborers, our subordinates, and so on. So, risks is the uncertainty. So, in Filipino, uncertain, no? So, not so sure. So, walang kasiguruhan. Ibig sabihin, walang kasiguruhan. Uncertainty. So, that is due to risks, no? So, we have this list of some risks, no? And maybe an engineering firm. First year is fire. Okay. So, yung may sunog, no? So, we cannot avoid it, no? If talking about an accident, burning, fire, so that is very dangerous. Not it will lose all our equipments and maybe our materials and our inventory because of that fire. Theft also. Okay, so from time to time, uh, we cannot avoid theft, especially for those people that need something that they can find in our firms or in our company. So, we should consider this as a risk. Then floods, especially if we are in the areas, low side areas, no? So maybe near to the rivers, river banks, no? So or in the and areas that is very easily flooded, no? So this will be considered also as one of the risks. Then accidents, no? Accidents that might happen to our operators, to our employees during productions, okay? Or even accidents that might happen in transportation of our supplies, goods, then accidents might happen, no? Okay, so non-payment of bills by customers. Okay, we call this one as bad debts, no? So if our customers might uh, feel that their company is losing, so we will be affected also, being the supplier of that company. Then disability and death of anybody, you know. So disability of our workers, our laborers, or death of anybody in our company, or death of anybody affected due to um, due to an what we call this one, intentional event or accidents. Okay, so we are going to consider this one as risks, no? So next we have the damage claim from other parties, no? So for example, if we have done, if we're not able to supply the services or supply the materials to our clients or customers in a contracted period, so we have to pay the damage, the liquidated damages, no? So that is just an example. Or for example, if we delivered these materials or this output of our company, and it has and it is defective, then of course they will claim for any damages of these materials. Okay, so we have these types of risk, no? We have the pure risks or pure risk. It is one which there is only a chance of lose, and it is insurable and may be covered by insurance. Okay, uh, that is the risk that the effect or the results will be losing of something, losing of life, losing of material, losing of property. Then this property or this life, this person is insurable, and we call that one as that risk as pure risk. The second one is speculative risk, no? This one which there is a chance of either lose or gain. This is not insurable. Okay, so this is a risk that supposedly we lose, but of course we gain because of this risk. Then this is not insurable. Okay, so what is risk management? So, as defined here, risk management is an organized strategy of protecting and conserving assets and people. Okay? So, that is risk management. Organizing and a strategy, thinking of a process, procedure, so that we will be able to protect the life of the people and conserving the properties that we have. Okay? Then that is risk management. Okay, so we have the methods of dealing with risk. First one here is risk may be avoided. Okay, so try to have programs and procedures, regulations in our company, in your company, so that the people or even the equipment and our property may be will not be affected with this risk, or maybe avoided. This risk may be avoided to preserve the life of the people and the loss of the property. Then the risk may be retained. Of course, they said that if we cannot avoid risk, then try to minimize risk. No, so maybe retained. If this risk is maybe retained, then try to think of deal with or try to think of the method that will be able to minimize this retained risk. No. Then number three, hazard may be reduced. Okay, so if we cannot avoid, if these hazards or risk may be retained, then try to reduce it. Okay, so we have several ways how we are going to reduce the hazardous activities, for example. Okay, so try to think of this reduction of these hazardous activities or risks activity. Then the losses may be reduced. Okay, so if the hazard is reduced, then the losses, possible losses, may be reduced. The last one here is the rest may be shifted. Okay, how you are going to shift the rest? Then of course try to avail the insurance corporations or insurance policies. Okay, try to insure your people that always be going to a risky activity, or your supply, your goods, your inventory, your building. Try to insure it so that whenever there might be an accident happen, then the insurance will pay the amount or whatever conditions that you agree with that insurance. They will pay for the recovery of that loose material or equipment, or even life of your subordinates. Okay, so we have some examples of efforts on loss reduction. No, so number one suggestion here is physically separating buildings to minimize losses in case of fire. So this is all about the warehousing, no? Warehousing of your inventory and supplies, no? So try to locate multiple buildings, no? And try to separate the supplies so that whenever there is an accident of fire, then not all equipments, not all supplies and inventory will be lost due to this fire. Okay, next, using fireproof materials in interior building construction. Okay, so that's very clear, no? So try to use fireproof materials so that the building will be uh, protected with this fire. Or storing inventory in several locations to minimize losses in case of fire and theft, no? So that's very clear, no? So try to warehouse or stock your inventory in separate locations. Okay, so maintaining duplicate records to reduce accounts receivable losses, no? So duplicate records. So of course that is very advantageous. Otherwise, if you lose the original records, then we don't have any way that we'll be able to collect all those receivables because we don't have any records or documents that support our collections, no? So next we have transporting goods in separate vehicles instead of concentrating high values in single shipments. So that's very clear that if we have several volumes or bulk supplies, transporting a supply, if you're going to transport supplies in a volume, then try to use separate vehicles. So otherwise, if accidents will happen during travels, then your supply will not be not all supplies will be damaged, no? So prohibiting key employees from traveling together. So this is very common in a company, no? That to minimize expenses, then we should have to use buses, for example, and all key officials will be in that bus. So what if accident will happen, no? So we will lose our key officials or key employees while in the travel activity, no? Or limiting legal liability by forming several separate corporations. So when it comes to legal liabilities, okay, so as much as possible, try to create sister companies and separate corporations so that if there is a legal problems, okay, in one of your company, then we can still work, we can still do our services or uh, production by means of other sister companies. Okay, so that's all. I think we finished discussing the financial management. I hope that you learned many things with regards to the management of the financial matters, no? In our company, in our firms, starting from the procurement of the funds, the determination of the needs, requirements of our firms for funding, then how you're going to procure and how you're going to utilize. And also don't forget with regards to the how you're going to minimize to solve risk in our companies because basically we cannot avoid risks, so try to manage risks. So thank you very much. I hope that you learn many things with regards to Chapter 12, the managing the finance function. Thank you. God bless. And see you next video.